Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, October 31st, 2022. And our top story today, Reconnecting Defined Benefit and Defined Contribution Retirement Plan Investment Structures. Today's show is powered by the Defined Contribution Real Estate Council. To learn more about the DCREC, its members, its mission, and to see its latest research, visit www.dcrec.org. Marco, welcome back to the program. It's great to see you as always. Thanks so much for joining us this morning.
Thank you so much for having me. Always a pleasure to talk to you.
Marco, we're going to talk about alternatives, and that we're going to get into that in a minute. But you oversee the UC Regents Retirement Program. And I thought for the benefit of the audience, people watching the program who may not be intimately familiar with your plans at UC Regents, tell us about the construct. How does it work? What's the typical retirement makeup?
Absolutely happy to do that. So if you look at the savings program, that's our defined contribution effort, our defined contribution product at the University of California. We serve over 320,000 participants in our 10 campuses, 5 medical centers. And it was really created, the savings program was created over 50 years ago to initially be a purely supplemental savings vehicle for participants or employees to save above and beyond their mandatory pension contributions. Today, over $30 billion in assets have been amassed in our 403b, 457, and our DCP, a 401a plan. Most of those assets, as I said, are actually still voluntary. However, really important to point out, and this is, I think, where we're going to have an interesting discussion and why we're thinking about alternatives in the DC space is in 2016, new hires have now the option, or since 2016, have now the option to choose a 401k-like primary retirement benefit. No access to the pension, contribution to a defined contribution plan, only 7% mandatory savings rate on the employee, and the 8% met on our employer side. So increasingly, we have a subset in our DC plan that do not have access to guaranteed income, do not have access to a pension anymore. And we're starting to look and feel a little bit more like many other corporate plans in the US, where we have over 20,000 individuals today that truly have a 401k-like benefit only. And therefore, that obviously has a ramification when it comes to thinking about longevity risk, hedging longevity risk, thinking about asset allocation and inclusion of asset classes. But hopefully that gives you a little bit of an idea of the plan that we're managing. About 30 billion, 320,000 participants.
That's a lot of participants. I have to go on record and say that. Let's talk about alternatives, because alternatives can mean a lot of different things. But when I think of alts, and I want to get your definition on this, I think of direct real estate. I think of private equity. I think of hedge funds. And there's so many different subcategories. Is there a disconnect between the defined benefit program and the DC plan when it comes to alts?
Absolutely. And maybe if we can start with the definition, because I agree, this is really important. Historically, especially in the defined contribution space, you heard DC plan sponsors talk about alternatives, about REITs, commodities, tips. Those, in my view, are not alternatives. At best, you can call them alternative 1.0, but you rightfully pointed out, what we really should be talking about is private real estate, private equity, absolute return strategies. And I think the UC is the poster child of that philosophical disconnect between how a pension invests and how a defined contribution plan, or for the vast majority of DC plans, how they invest assets for participants today or offer solutions for investors to invest their assets. Marco, as a participant of UCRP, that's our pension, has a 30% implicit allocation to alternatives, 12% private equity, 7% private real estate, some absolute return strategies, some real assets. Same individual, Marco now looks at his DC lineup and the offerings that we offer under the hood of the target date fund, for example, no allocation to alternatives in a traditional sense whatsoever. Currently, our target date fund, we have over $14 billion in Pathway, our target date fund today, no alternative exposure. So we at the UC are a prime example of that philosophical disconnect that for a pension, it is good and it is important to have alternative assets. Yet the DC plan that we offer for our participants today is absent or is not offering any of those asset classes that are really important from a diversification and an expected return perspective. So the UC is a prime example why there's a philosophical disconnect in the US today.
And why the hesitancy? I mean, when you think about you're a fiduciary on both plans, not you in particular, but there's a group of fiduciaries, people that are responsible for the plan, and ultimately you have to do the right thing to benefit the participant. So why the hesitancy? Why the disconnect? And even a plan with 320,000 participants, sizable assets, you already are using alts in the DB plan. Why the hesitancy, do you think?
When you talk to plan sponsors, and we're in a similar boat, you will usually hear three reasons why it's on the defined contribution side more difficult or more challenging or more risky. Number one is fiduciary risk. Often, we're not subject to ERISA. Many, of course, 401k plans are subject to ERISA. So fiduciary risk, the risk or the fear of getting sued for incorporating alternatives is always first and foremost being mentioned when you talk about the hesitancy around incorporating alternatives. Fees is another one. And that's true for the UC as well, have been a victim of our own success. I have, over the last 5 years, touted the reduction of our fees in our DC plan, where we're able to reduce it by almost 70% over the last 5 years. So we've created that mindset in our governing structure, in our governing board, that low fees are a good thing. And of course, now trying to explain why alternatives with a much, much higher management fee and administrative cost are a good thing is now, in a way, going against that very argument that we've been making, that reducing fees and being cost effective is a good thing. So fees is the second very important, often brought up topic around why we might not want to do that. And then the third and final one is operational aspects. Usually what you hear is daily valuation. These funds or these structures are not daily valued or often not daily valued. There's liquidity constraints with these products, and that's why a daily valued defined contribution setting is not the right space. All of those reasons, in my view, in our view, are increasingly a convenient way to not have to talk about alternatives. And indeed, in many instances, there are solutions and ways to actually mitigate all those three main reasons and hesitancies why alternatives are not in the core lineup, certainly not under the target date fund asset allocation hood today.
Yeah. Well, Marco, I need to take a very quick break. When we come back, we'll talk about overcoming some of these concerns and a lot more. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back, and a reminder that today's show is powered by the Defined Contribution Real Estate Council. To learn more about DCREC, its members, its mission, and to see its latest research, visit www.dcrec.org. Marco, thank you so much for staying with us this morning. Really appreciate it. And I haven't chased off a guest yet. Thanks so much.
Absolutely. How could you ever chase me away? I love doing this.
Well, I could never chase you away, but I'm always concerned, that someone's going to leave during the commercial break, and I'm going to be left talking to my cat. Okay, so what I want to do before we get into overcoming some of these barriers, let's talk about performance. And you mentioned fees, and look, I lived through, and you lived through the fee disclosure rules in 2012, and we've even seen cases, to your point, in the first segment. We've now seen the litigation come full circle. Now there's concerns about passive investments and low-cost investments. So I still can't figure that one out. But talk about comparative performance, net of fees, and how alts, an allocation to alts can really, bump up, improve the net return for a participant, and ultimately get them into retirement.
Yeah, and I think this, Jeff, if I'm go step back for 1 second, is at the crux of why this is so tremendously important. Is if we look at our expected return forecasts for publicly traded asset classes, public equity, public fixed income, and I think this is consistent across the industry. Expectations, return expectations going forward are significantly lower than what we've seen in the past, and with the benefit and the luck of all of us living in an era of living longer comes increased longevity risk. So we need to make sure that expected returns, especially for our default, our QDIA, our target date fund, are optimized. What does that mean? If I look at our pension today, and if I look to take the two prime alternative asset classes in our pension, private equity, private real estate, and compare that return over the last 10 or 15 years to public equivalents, I'll start with public equity. Our private equity portfolio over the last 15 years has outperformed their public equities by 250 to 300 basis points after all costs. So this is not a gross fee, that's indeed a net fee improvement in performance relative to public returns. You're going to see this in the real estate space equally, not quite as strong, but still in the low 200 basis point range of increased performance over a 10 to 15 year time horizon. And as I mentioned earlier, our pension has 30% of alternatives from an asset allocation perspective. So if I cost average that out, if I look at this from an average return perspective, I'm able to add an annualized 1% increase in returns if I add 30% of alternatives at the top line. That is a meaningful increase in returns, and it is net of fees. So I think the biggest challenge and the biggest aspect of changing the narrative away from cost and fees to performance after all cost and fees is going to be critically important. That's the groundwork that we've been laying for a number of quarters with our governing boards to continuously reiterate that low cost alone is not necessarily most optimal asset allocation, and certainly doesn't lead to most optimal return expectations if you simply say, let's go with the lowest cost route.
Just to follow up on that, Marco, how do we overcome some of these barriers that you described, the three main concerns? And I can tell you, I can name a few. I'm not going to name them on the program, but I can name a few plan sponsors today that are using alts in their DC plan. But what do we do as a industry? And I'll lump myself in there because I was a consultant and now I'm a advocate, I'm going to say. But there are consultants, financial professionals, asset managers, record keepers, and even plan sponsors and journalists who are watching us talk. How do we overcome these barriers?
And I think you're getting at the heart of what is important, is that it takes a village to make that mind shift happen. So I think the trifecta of plan sponsors, asset managers, and consultants working together as an industry and trying to change the narrative, trying to change the message around cost to let's really think about outcomes is going to be critically important. And obviously, when you talk about asset managers, they have been trying to do this all along. The challenge, of course, there is that it's often perceived to be self-serving. And to some degree, of course, it is. So I think it takes a village. I think it will be extremely important to work with plan sponsors, consultants, and the asset managers together. We form, I would like to call it the trifecta, the alliance of advancing alternatives. And the most important and critical aspect is going to be changing the narrative every single time all of us are talking about outcomes. We're talking about return of our target date fund. It is always focused first and foremost on expected outcomes and real outcomes and fees next. So the narrative needs to be turned on its head. We've done that over a number of years to lay the groundwork to incorporate alternatives in the defined contribution plan. From a valuation perspective, the operational side, I think there's been so much work that has been done. I think sometimes it's also demystifying the needs around liquidity. If I incorporate alternatives under the target date fund, why do I need daily liquidity? Why does my private equity sleeve need to be able to offer me daily liquidity? Why does my private real estate exposure need to offer daily liquidity? I can handle that through my overarching asset allocation framework and source daily liquidity that's needed through my public sleeves on the public equity or the public fixed income side. And then on the fiduciary risk side, I think, again, there it is going to be critically important to change the narrative to outcomes matter, not fees matter. And especially on fiduciary risk, and of course, my legal team probably will get a heart attack if they will hear me say this. But at the end of the day, as a plan sponsor, and you alluded to this, even if you go to all index, you can get sued now. You can get sued for action or inaction. If we end up getting sued, let's get sued for action that ultimately improves outcomes. So I think there's a little bit of a boldness needed also on the plan sponsor side to take on a little bit fiduciary risk, because you are just as likely to get sued for not doing something at this point in time. So let's just get sued. And I'm joking, obviously, but let's get sued for the right thing. And that's why we've been pretty bold on innovating in our RDC plan. We incorporated an annuity guaranteed income in our target date fund. You could argue that's more illiquid than private equity or private real estate. Our deferred annuity doesn't pay for 15 years until guaranteed payments start. So we are not shy of being a little bit ahead of the curve. But to your point, some plan sponsors have done it already. We just need to come together as an industry and really drive that message of expected returns is what matters, not lower fees.
And it sounds like just don't overcomplicate it. And as you're talking, I'm thinking, in 1969, we put men on the moon. 1969, that was 53 years ago this past July. If we can do that, some of the operational challenges, and that was 1969 technology. It's about not complicating things, right? And keeping things fairly simple. And these are conversations you can have as a committee with your consultant, with your record keeper, with your asset managers to figure this out. It doesn't have to be wham, bam, we're done in 60 days. It's a thoughtful process, and that prudent process actually is going to protect you from those lawsuits.
I absolutely agree. And especially on the operational side, there's been so much work that has been done, especially in the private real estate side, where daily valuation, daily valued private real estate funds are readily available. And from our perspective, if you think about sequencing of incorporating of alternatives, I think that is going to be the right way of thinking about it. Private real estate is probably where we've seen the most adoption and where it's most sensible, because the fiduciary structure, the fiduciary comfort, but also the operational framework and valuation in daily liquidity are much more mature than they are on private equity. So I do believe that when you look at the evolution and the incorporation of alternatives in targeted funds in particular, it's going to be private real estate first, private equity next. Even though, having said that, and I think this is true for us in particular, is that especially from a risk and return improvement perspective, private equity is where really most of the return improvements will come from, simply because the allocation in our target date fund is a prime example. We only hold 5% of REITs across the glide path right now, where public equity, of course, are a 10-fold and sometimes even 15-fold of that weight. So just from a return improvement perspective, private equity is going to be the more important, in my view, area of incorporation. Having said that, private real estate is much more readily incorporatable. And from a fiduciary risk perspective, I think also much more settled when it comes to incorporating them in the DC space.
Well, Marco, I think we're going to be talking about this topic for some time to come, and I think it's a healthy conversation. We want to have these types of conversations. Thanks so much for joining us, and we look forward to having you back on the program again very soon, my friend.
Thank you. Always good to see you, my friend. Take care.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, entertainment, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, or visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.